In this video, we're going to discuss the balance sheet. What you see here is an Excel file where I've listed the categories of as many balance sheets items as I could think of. I know we went through this briefly in the first day of class, but I don't think it hurts to review it once more. Then we're going to be reviewing Target's balance sheet, as you can see here with its headings and subtotals and totals. Then we are going to work on creating Target's balance sheet from a scrambled version of Target's balance sheet accounts. So to begin, let's just quickly review the balance sheet. I know you remember this going as far back as Accounting 221. If you remember your final exam where you had to create a balance sheet, you're probably thinking, why do we have to do this again? Because it's really important to know the classifications of each and every item. Even if this is just review, it's important not only when we're looking at financial statements, but also to be able to do this for the CPA exam on the financial accounting section. All right, remember the classified balance sheet has splits our assets into current and non-current or long-term, and splits the liabilities into current and non-current. Under current assets, we have cash, accounts receivable, typically shown net of the allowance for doubtful accounts. Inventory. Remember from last week we discussed short-term investments. They might also be called marketable securities. Clearly, if they're called short-term investments, they're going to be current. If they're called marketable securities, typically they'll be listed as current, but they may possibly be listed as non-current if the company's intentions are to hold them for more than a year of the balance sheet date. Prepaid assets, also called prepaid expenses. These items refer to prepaid rent, prepaid insurance, prepaid taxes. You're not going to see this account, prepaid assets or prepaid expenses, on the 10Ks of publicly traded companies. They're simply too big. They'll probably be lumped into an account called other current assets. But on a smaller company, perhaps the company that you'll own, your CPA firm some point in the future, you might list prepaid assets as a line item. And same goes with supplies. A subtotal needs to be shown for total current assets. And before I get to my non-current section, I've just listed 3 accounts here that may be current or non-current depending on the economics of this asset. Notes receivable, deferred tax assets, and investments in unconsolidated subsidiaries, although those investments in unconsolidated subsidiaries should typically be non-current. So let me take that out of there. We see it in non-current. Under non-current, we have deferred charges. Deferred charges is the same as those prepaid assets, but once the prepayment is made for a period longer than 12 months. In other words, the benefit, prepayment has been made, and that benefit is going to be reaped over a period more than 12 months. Capital lease assets, the company actually doesn't own that, doesn't own the asset, but it records it under a capital lease. That'll typically be shown non-current. Plant, property, equipment. Below that, where companies will report accumulated depreciation on the plant, property, and equipment. Intangible assets other than goodwill. What are we talking about here? Patents, trademarks, franchises, copyrights. Remember, these are all items that have been purchased from another organization. These are not internally generated. Why are we separating intangible assets other than goodwill from goodwill? Goodwill typically is not amortized over its estimated useful life. Accountants say, the FASB rules, GAAP rules say that we don't know how long goodwill will last, so we test it for impairment each year. On the other hand, intangible assets, most intangible assets, patents, trademarks, franchises, copyrights, are for a limited time and are amortized over their useful lives. Equity method investments, also called investments in unconsolidated subsidiaries. Long-term debt or held-to-maturity investments, as well as long-term marketable securities, and pension assets. We will show, typically the balance sheets often do not show the subtotal for total non-current or total long-term assets. Some may, but they will all report, of course, total assets. Now let's take a look at our liabilities. First, the companies will report their current liabilities, accounts payable, accrued liabilities, also known as accrued expenses. These referred to anything that is not listed elsewhere, any payable not listed elsewhere. Typically, they're going to relate to items such as wages payable, salaries payable, taxes payable, utilities payable, and or interest payable. Remember from last week's video, the current portion of long-term debt must be separated and reported as current. Commercial paper, this is not an investment in commercial paper, but if the company has actually issued commercial paper, that will be listed under current liabilities. And dividends payable. When we look at these items that may be current or non-current, why are these items up here typically listed as current? Well, you can't play your inventory with payment terms that don't involve interest charges more than a year. You can't promise your employees you'll pay them their salaries in a period over a year. You can't take longer than a year to pay dividends to your stockholders. So these tend to always be current. Unearned revenue, also called deferred revenue, is typically a current liability. Usually our customers are not paying for more than 1 year, but it is possible that the customers could be paying more than 1 year in advance, in which case we can have one portion of it be the current and the remainder be the non-current portion. Notes payable, deferred tax liabilities, and warranty obligations, current or non-current, depending on the economics of these items. Typically listed as non-current, capital lease liabilities, bonds payable, mortgages payable, long-term debt. Remember, long-term debt is just a very general way to list amounts owed for a long period of time. So bonds payable and mortgages payable are types of long-term debt. But if a company just has one line called long-term debt, we don't know the specific type of debt. These are just several different items that are not independent of one another, but that you might see on balance sheets. And finally, pension liabilities. The company may report total non-current liabilities, but they most certainly will report, well, actually they don't all report total liabilities, but many will. Finally, the stockholders' equity section. First is going to be listed common stock, then the additional paid in capital on common stock, the amount paid above par value. Preferred stock may go here, but oftentimes preferred stock is going to be reported somewhere where I've highlighted in between liabilities and stockholders' equity. Preferred stock is typically considered a mezzanine section, not quite debt and not quite equity. If you think about who's using the financial statements, it's typically the common stockholders. So from the common stockholders' perspective, they often want to look at preferred stock isolated out of their ownership. We have retained earnings, the profits that are reinvested in the company that have not been paid out as dividends. Accumulated other comprehensive income. I know we went through this in the beginning of the semester, but this is one of the more tricky accounts. Accumulated other comprehensive income is the obviously accumulation of the gains and losses that have been unrealized. Some may consider that they should be included in income, but there's arguments why they should not be included in income. Remember, items in here are certain derivative hedges, certain changes to the pension asset liability, pension gains and losses, and also unrealized gains and losses on foreign currency translation all affect accumulated other comprehensive income, or AOCI. Treasury stock, this is the account where we're classifying the common stock that the company has purchased back from the market and is no longer outstanding. And remember, if a company consolidates its financials with the subsidiaries that it holds majority ownership in, but doesn't hold the entire portion of, doesn't hold 100% ownership in the shares of the subsidiary, all of these balance sheet items, except for the equity portion of non-controlling interest, include the combined financial information. This equity portion of non-controlling interest is simply the portion of the stockholders' equity not owned by the reporting company or the parent. And finally, we have our total stockholders' equity, and typically we'll see a line for the total liabilities plus the stockholders' equity. Now what I want to do is a similar exercise to what I did on the income statement, but this time with the balance sheet. So you'll see in the target file, target.xlsx in Blackboard, you'll see Target's balance sheet and also a worksheet called Balance Sheet Scrambled. I have mixed up the order of the accounts And at the bottom, I presented the headings and the subtotals and totals. These subtotals and totals will be helpful for checking our work as we go along. I like to think of this as a puzzle that we get to work through in creating our balance sheet. All right, so I know the top of my balance sheet is assets. I'll start working over here. And then if I have a header for current assets, I do not. So I'm going to go right into first current asset. I'm always going to see cash. Next, I'm not going to be too worried about the order. The company is going to report their current assets in order of liquidity. Now, I'm not sure what the company's liquidity is of their inventory versus receivables. So I'm just going to make sure I have them in the correct classification. I know that inventory is indeed a current asset. Looking for any other current assets here. Well, we have something called other current assets. That's clearly going to be here. That it will always be shown as the last current asset. So if I find any more, I'm going to need to move this down a bit. All right, so that looks like everything. I'm going to put in my subtotal here and make sure that I haven't missed anything. Highlight these three current assets, and indeed that ties to my total current assets. Then the next section is going to be, oh, here we go, property and equipment. There's nothing else related to nothing called long-term assets. So I'm going to put the property and equipment in here next. This is Target. A big investment that they have is in their computer hardware and software. So they record that separately from their buildings, land, and other equipment. Here we have buildings and improvements. Fixtures and equipment. I see the next line, accumulated depreciation. I'm going to need that to go somewhere, but two more items that I have here. Well, construction in progress. That sounds like it is part of property and equipment. And land. And let me see if the next thing I believe is going to be the accumulated depreciation. And once I factor in my accumulated depreciation, I should now get to my property and equipment net of accumulated depreciation. So let's see here. Yep, that works, so I didn't miss anything. All right, before I move on to total assets, I need to check to see if there are any other long-term assets that I did not include here. And I see one general account called other non-current assets. Let's put that in. Take away some of these spaces, and next this should agree to my total assets. Let's just check that before I move on. My total assets should be equal to my total current assets plus property and equipment net plus other current assets, and looks good. Now I'm ready for my liabilities. I'm going to start with my current, I don't have a current liabilities header here, but I believe that I should. Just liabilities and shareholders equity investment must be the next line. And let's start with the current liabilities. I see accounts payable. I see accrued and other current liabilities. I see the current portion of long-term debt and other borrowings. And I don't see anything else, so let's see if this ties to the reported subtotal for total current liabilities. And it does. Great, so I'm going to move on to non-current liabilities. I see deferred tax liability non-current. long-term debt and other borrowings, and other. I'm looking for a subtotal that either shows total long-term liabilities or total liabilities. Yep, and I have something for total non-current liabilities. There is no subtotal for total liabilities. So the next thing I want to do is report the shareholders' investment. Get rid of this extra line here. First item should be common stock. See common stock here. Additional paid in capital. And you'll see that some companies actually combine common stock and additional paid in capital. There's really no reason an investor would need this separated out. Retained earnings. It's going to follow. And accumulated other comprehensive loss. And that looks like I've allocated everything put together and put in my last piece of the puzzle. So I'm going to show my total for shareholders investment. Check to make sure that this agrees. Yep. And my total liabilities and shareholders investment should equal to my total stockholders equity, total non-current liabilities, and total current liabilities. 38999 looks great. I can check my work by, I'm just going to delete this. I can check my work by making sure that everything on my balance sheet agrees to what was reported on the worksheet called BS, and keep in mind that that stands for balance sheet. And I can go back and forth and make sure it all matches, and that's it. Next, what I would like you to do is work through the practice problems. You can see the directions on Blackboard, but you will be reconstructing the balance sheet and income statement for both Walmart and Costco.